In this week's update, is the bear market complete? That's not the right question. The right question in just a minute. My name's Garry Davis. As always, this is general advice, and please remember to like and subscribe to the video. All right, let's start with a bigger picture look, and perhaps one which I think is probably described as the worst case scenario, and that's a period of stagflation. And that's defined as having high inflation, but economic growth basically stalls or even goes backwards. So that's the worst of all scenarios, and it's obviously one that central banks are trying to avoid, but it's going to be difficult. So the Fed and other central banks around the world are trying to reduce inflation whilst avoiding a recession. Now, at the best of times, that's a difficult task. And the Russian-Ukraine war has made things worse because it's had a huge impact on supply chains around the world, on commodity prices, and we're now starting to see an impact on economic growth. So that is something that's overlaying what was already going to be a difficult situation. So certainly the outcome or the outlook is rather uncertain from an economic point of view. So I thought it was worthwhile just having a look at what happened the last time we had a period of stagflation, which was in the 1970s. And at the index level, as you'll see, it wasn't a disaster looked at over a 1 to 2 year time frame. And at the sector level, there was some extraordinarily good outcomes. So let's take a look, first of all, at that period. So this is the S&P basically running from 1968 through to 1988. So we're looking at 20 years of a monthly chart. I beg your pardon. Now, what happened in 1973 and 1979 to 1980 were there were two energy shocks that interrupted Middle East exports of oil. The first one was the Yom Kippur War, and the second one was the Iranian Revolution. And those two shocks certainly led to a period of stagflation, as I described before. So if we look at what happened, and this is the S&P, so this is at the index level. So this first period here, marked by the green bar from 1973 to 1975, and all I've done is just taken the 1st of January to the 1st of January, just for the sake of consistency and not appearing to cherry pick results that that suited what I'm saying. So that's just that 2 year period from January to January. So in the first period, the S&P from peak to peak across that period was down 13%, which, given the impact on the global economy, was incredibly severe. Just points to the fact that yes, markets go down, and bear markets can be 30, 40, 50%, but markets always recover and go on to very, very significantly higher levels, because the S&P in those days was around about 100 points, and now it's around 4,000 points. So you can see the long-term benefits of being invested in the stock market. But if we look at the worst-case scenario, and that was peak to trough, so from the start of January in 1973 to the lows, which occurred in October 1974, so about 20 months later, it was a 45% peak to trough drawdown. Move forward now to 1979 to 1980, and guess what? The S&P index went up, and it actually rose from peak to peak. So the highest point at the start of 1979 to the close at the start of January 1981 was a 34% gain at the index level. Now, of course, different sectors did incredibly well, and certainly during this period, in energy stocks, I assume did extremely well. Now, I don't have charts for this within Optima, and I couldn't find them anywhere else. The only chart that I could find that went back that far was General Electric, GE, so I went back and I looked through all the components of the Dow from 1965 through to 1985 and tried to get data on every single company that was listed in the Dow Jones during that period. This was the only one I could find. So this is 1975 through to 1981. And you can see from 1975 through to let's say 76, GE went up quite significantly, went up by more than 50%. And then it just went flat and then it went up again. So there's one company, it's the only one I could find, but there's one company that actually went up during a period when when the stock market was perhaps struggling with stagflation. So if indeed we end up with a period of stagflation, it's not the disaster that you might think, and there will be some sections that will do extraordinarily well. So obviously they're the ones that we want to be in. So that's the worst case scenario. Now, the right question to ask, rather than is the current bear market finished or not, because we can't know the answer to that until months down the track, when we can look back and we can see a progression of higher highs and higher lows. So it's just not the right question to be asking at the moment. The question is, how do we manage through this period, which is pretty uncertain? The weight of evidence suggests that the bear market has finished, but that's not a guarantee. So, how do we negotiate this period while we're finding out whether the bear market truly is finished or not? So the big picture is that markets rise most of the time. So if you look at the last 30, 40, 50, 100 years, markets go up, and they spend a lot more time rising than they do going down or sideways. So the question to ask is, what can we do to take advantage of the opportunities? What sectors do we focus on? How do we manage our exposure? And how do we do things without undermining our psychology? So they're the smart questions to ask and to focus on, rather than, wringing your hands about the red on your screen. The most precious asset we've got is an open mind, and I've said this on many occasions, and most of the people that comment on this YouTube channel are pretty realistic about the market. There's some others that I'll get to in a minute that don't seem to have an open mind, that seem to have a need to be right in their view. But it's really the open mind and the flexibility to run with the signals that the market is giving us that's the most important. Now, last week, I said that and I've been doing this now, building up for about 3 or 4 weeks, I said the weight of evidence points to an end to the bear market. It's not guaranteeing that it's finished, it's just saying the weight of evidence is pointing that way. But I also said that this is a pretty tough environment, and so it's unlikely to be a V-shaped recovery. That would seem a logical conclusion to me, because we've been conditioned to V-shaped recoveries out of bear markets for the last 30 years. But we've now swapped from falling interest rates for 40 years to now very likely a rising interest rate environment. But again, it's too early to say that interest rates are going to go up for the next 10 years. They might go up for the next 6 months, but then who knows after that. So we're in a very different environment. So I think it's logical to conclude that we shouldn't expect a V-shaped recovery, and that perhaps something more like a W-shaped recovery might be more like what we get. But again, let's come back to the most important commodity is an open mind and the flexibility to change your positioning in the market if it's warranted. Now, this week, as we'll see when we get to the charts, there are lots of what I'd call undecided candles. There's still nothing really definite. But there are a couple of things another couple of boxes that indicate to me that, the bear market weight of evidence has strengthened again a little bit. So let's take a look at what those two are. So first of all, let's look at the VIX index. So if we look at the VIX, this is the VIX year to date. Now, the VIX, as we know, has been above 20 all year. It's peaked out on an intraday basis at close to 40 on a couple of occasions. But you can see just the last little period from, this is the last 2 weeks, we've now got lower highs and lower lows. Now, we've had that before, and then the VIX kicked up again. And you've got to understand what the VIX is. The VIX is not telling us about today. The VIX is telling us about expectations for the next 30 days. So the market is looking out 30 days at each one of these points in these lower highs and lower lows, and it's telling us what the expectation of market participants is. And market participants are saying we expect the fear to subside. And that's obviously what we're looking for, to be consistent with the end of a bear market. Not a guarantee, but again, it's weight of evidence. Let's look at the 10-year Treasury. Let's look over the last 6 months. So we've run up to a peak of 3.48%. But what has happened in the last week? My goodness, that's annoying. What has happened in the last week or two is we've come off from that high of 3.48 and we finished at 2.9. Lower highs, lower lows, but also we've broken below this peak of the 9th of May. So, to me, that's just one more little bit of weight of evidence. Now, this can always turn around and go back up again, but we just keep racking up on one side the boxes that are getting ticked that suggest that a bear market is either finished or it's close to being finished. And that's all we've got in this whole discussion. All right, so look, the most likely way forward from here, in my view, is that we end up with a quite volatile road back to new market highs. Now, are those new market highs in 3 months, 6 months, 18 months? We'll wait and see and find out. And I don't give any real thought to when that might be, because it's pointless. It is absolutely pointless to try and think about when that might occur. We just know that it will occur because it always has in the past. But along the way, we also know that some stocks are going to do incredibly well. Others are going to struggle, and many are going to die. They're going to run out of money, they're going to become obsolete, they're going to close their doors. And there's been quite a number in Australia of businesses that have closed their doors this year. So that's going to be the reality going forward. So my overwhelming advice, as it has been for a long time, is that investors need a very clear picture of what they want their portfolios to be composed of. I said last week, there are some things in the market we can't control, but most things we can control. And we can certainly control what we want our portfolio to look like. We just need to make some decisions about what is the most appropriate composition. And that's what I'm talking to my members about all the time. And just in the last week or so, we've been selectively buying a few very attractive stocks that should do very well over the long term. Stocks that can do well in an inflationary environment, but an environment where decarbonisation is going to remain a very powerful, and you'd have to say, an unstoppable theme. It really is extremely difficult to see how decarbonisation for the next decade is not going to continue to be, an incredibly strong theme. All right, so there's a few more major boxes being ticked, as I indicated. The VIX index is trending lower. Bonds are being bought. The 10-year yield is coming down. That means bonds are being bought. So that means one of two things, because bond traders are not buying bonds for fun. These guys tend to be a lot smarter than participants in the stock market. So if they're buying bonds, then one of two things is happening here. Either they're expecting that inflation has peaked, and or they're concerned about a recession. Now, if we get a recession, then that's going to cool the inflation rate of inflation anyway. So there's another couple of boxes that have been ticked. We still don't have the one that I really want to see is the emphatic reversals in what don't think we're going to see it at the index level, but I certainly would like to see it in some of the stock levels. And I'm not really quite seeing that yet. There's a few, but it's not enough. So that's a box yet to be ticked for me. But look, we're coming up on earnings season in the States. It's really vital, the nature of this earnings season. Prices have come off a great deal. That has restored value. The average PE now for the S&P is now down under 20. So that's sort of re-established some long-term value. But the problem will be is if earnings fall significantly and analysts start downgrading the outlooks, then the PEs and the prices could come down another level. So this US earnings season really is quite important. Look, just one final thing. There's been a few recent comments on this video expressing certainty, if you like, about what will unfold. And those comments have been both bullish and bearish. Some of these people are going to be proven to be correct, pretty obviously, because if some are bullish and some are bearish, one side of that argument is going to be right. But my question is, what is their plan if they're not right? What if they're standing on the wrong side of the boat and the outcome that they think is almost certain to occur doesn't occur? What are they going to do then? So, it comes back to this thing about what's wrong with having an open mind and being flexible. We don't invest to be right. We invest to make money. I think it's just good practice to leave our ego at the door. It always has been the case and always will be. All right, let's move on now. Let's review the American stocks. The S&P ended up losing 2.2% for the week, but not too bad a finish on Friday. But semiconductors, which is an important sector for the resumption of a bull market, semiconductors are really important, and semiconductors are being hard hit at the moment. So, that slows me down a little bit, seeing what's happening in that sector. The US dollar index went up to 105, the 10-year yield, as we saw, and the VIX, and the 10-year spread is still positive, but only just 0.04%. All right, let's look first of all at the semiconductor sector. So you can see all the moving averages have rolled over, and on a night when, certainly some other tech stocks went up, semis were hit, and the volume was elevated as well. So that was very disappointing from my perspective, and I really need to see that sector turn around. All right, let's take a look at. All right, let's start with the Nasdaq versus the S&P, and this is something that I think is worth looking at. When I started thinking about, well, what happens to this ratio chart as we flip from a bearish market to a bullish market? So the S&P, let's go back to 2008, the GFC. The S&P formed a double top, one in July of 2007, one in October of 2007. It then fell, and then it rallied from March to May of 2008, and then eventually bottomed March 2009. So that's the S&P. Now let's look at what happened in this ratio between the Nasdaq and the S&P. So we peaked in November. So between July and October, when the S&P was basically going up and down, forming that double top, growth stocks were being favoured. That's what this is telling us. The line was rising, growth stocks favoured. Then from November to February, money was coming out of growth stocks and going into defensive stocks. And that is when that was consistent with the market falling. We then had during that period where the S&P rallied from March to May, the Nasdaq did even better. So this is March to May, and the Nasdaq outperformed significantly. We then got a decline, but look where it bottomed. This ratio bottomed at the end of November 2008. The S&P didn't bottom until March 2009. So as we got towards the end of the bear market, which really lasted from October, November 2007 to March, so it lasted about 18 months in total, with quite a few fluctuations. But this ratio turned up 3 months, nearly 4 months ahead of the S&P. So that's why these ratios are so important to look at, because they're early warning indicators, both on the upside and the downside. So let's come forward to today. And we peaked out here, formed a peak in September. We then had just basically a big sideways period. We peaked in February of 2021, and then we peaked again at the end of November. And since then, we've been in decline until very recently, when we've just started forming higher highs and higher lows. Now, it's not very definitive. This is anything but a V-shaped recovery. But at this point in time, we can say that we've got higher highs and higher lows. Now, that situation may get reversed, but at the moment, that's what we have. And all transitions from a bear market to a bull market have to go through this period of either V or W or some other shape where we basically get higher highs and higher lows. So that is the current status of the money flows between defensive and aggressive sectors. This is consumer discretionary versus consumer staples. Higher high, well, it's getting a bit touch and go, but we don't have a lower low yet, so we haven't violated, but this isn't looking all that encouraging. And I guess this one is not surprising, because the US consumer is really going to get squeezed with higher inflation, higher energy costs, higher interest rates. It may well be that this time we get a situation where the consumer discretionary ratio doesn't rise with the rest of the market. Anyway, we shall see. This is Russell 1000 growth versus value, so you probably call this a mid-cap, and we definitely are getting quite emphatically higher highs and higher lows. So this one is quite encouraging. If we look at the small caps, growth versus value, again, we've got higher highs and higher lows. So there certainly are some encouraging signs. They're not all complete at this point in time. All right, let's take a look at the S&P and how it finished. So you can see quite a roller coaster week. We had some strong finishes the Friday before, the 24th of June. We were then down for most of the week, but turned around on Friday and went back up. So not too bad a finish there on the S&P. The Nasdaq, not quite as strong as we saw, and therefore that ratio fell a little. If we look at the Russell 2000, so this is for small caps. Again, we're seeing signs that the strong downtrend is perhaps, moving to some sort of consolidation. I'll show a couple of other charts of interest. This is Microsoft. This looks like a consolidation, more of a consolidation. It looks perhaps like the downtrend is finished, but we do need to get up above around $280 on Microsoft to feel that we're moving back into an uptrend. This is Apple, and again, the reason I'm looking at these charts is there's just the absence of that really decisive big reversal candle that just engulfs everything else. Big volume. We're just not seeing that. And there's Google. We're not seeing it there either. So that is the current state of play with the US market. If we look at the currencies, ended up rising slightly, but it's just struggling to get through this sort of 105.5 level. And the Australian dollar is pretty much mirroring that action. And you can see we had a huge gap down on Friday, traded up a little bit, but finished at 67.5. So we actually gapped down below this important support So if this breakdown confirmation, if we close below it, then we're looking at the 64s or possibly even down slightly under 60. And certainly the iron ore price, which is coming off very sharply, is not going to be helping that situation at all. So 67.5 was where our currency finished. Our index was only down 0.6 across the week. It was in a roller coaster, just like the American market was. We went up strongly on Monday in response to the prior week finish in the US, but we came down hard, and it's really only large caps with earnings that the market is tolerating to any degree at the moment. Most small caps across, doesn't matter whether it's mining or healthcare or technology, are getting beaten up pretty badly. So, and again, this is not unusual. This is what normally happens in a bear market cycle. And it's when the money starts flowing back into large caps that, there's a bit of light at the end of the tunnel. Now, turning to precious metals, gold lost another $16 to $18.12, but there was a big reversal on Friday night. And I think the interesting thing about that is that the US dollar was higher, and yet we still got a big emphatic reversal, which it's only one day, but certainly looks encouraging. And if we are headed towards a stagflation environment, then traditionally that has been a good period for gold. So that might be the saviour for gold in the end. It won't be good for broad sections of the stock market, but it certainly might be okay for gold. Precious metals, GDXJ, as we'll see, there was a big stock reversal there as well. So let's take a look at the gold price. So you can see quite a nice reversal there on Friday night. We actually traded down to a low of 17.85 before bouncing. Looked out on a weekly. Really, we're at the same level that we were at in July of 2020. It's just been one big mess of up and down. Turning to GDXJ, you can see that's a nice reversal. That's the sort of reversal that I'm looking for, where it gaps down, trades right up, long range candle, closes near its highs, and the volume is rising. That's what I'm hoping to see in some of the other stocks in America. So that's quite an encouraging sign for gold stocks. But look, we've been disappointed time and time again. So just be careful in the gold sector. Local gold producers in Australia have been sold off last week fairly heavily. We're seeing rising cost pressures coming through. We've got a gold price that's going nowhere, and we're now starting to see some production downgrades. The difficulty of getting skilled labour in Western Australia is starting to bite. And, these are transient factors. They're going to get solved, but they're not going to get solved overnight. So the outlook for Australian producers is not all that great, despite the fact that the Australian dollar gold price is I think 26.80. So the margins for a lot of producers is very significant. Although the all-in sustaining cost doesn't really capture all of the costs, and so some of the margins that gold miners are reporting are not as good as they might seem. But certainly for many, the margins are extremely robust. But the outlook, the sentiment around the sector in Australia is just pretty sombre at the moment, I've got to say. Other commodities, copper was lower again, 365, and that is certainly, it's often said that copper is a barometer of global economic health, and copper having fallen as sharply as it has is on its own is saying that we're heading to a recession. but that's you can't just take that one signal on its own. Nickel was also down a bit further, and so we've got these fears about recession, and it's just in the short term, it's just trumping the reality of supply and demand, and the fact that decarbonisation, no matter what happens in the short term, decarbonisation is going to drive this supply and demand imbalance for the rest of the decade. Lithium, those prices still remain extremely buoyant. The crude oil, again, had about a $10 weekly range and finished up slightly in the middle of that range at 108. So there's the copper price chart. We've fallen from $4.50 in May, and we're now down towards the mid threes. There's the copper inventories. They started to build up a bit through here, which would help explain some of the price fall as inventories built. But then inventories have come off again. So the falling price is not because inventories kept rising. So this is a very confusing picture that I'm seeing in the copper market. This is the spot nickel chart. Didn't really react to the downside very much last week. So wrapping it up, management of risk is always important, but it has an even greater priority now. There are always great opportunities in bear markets. Through this bear market, we've seen energy do extremely well. In the States, we've seen renewable energy start to recover, and we've seen some selected stocks, very selective, but some, do quite well. So there are always opportunities in bear markets. It's just there are less of them. You've just got to be more selective about what you're in. The weight of evidence suggests that the index bear market is finished, but not all the boxes are ticked, and that is not a guarantee. Some sectors will lead upwards well before the index turned. We saw with the Australian market and the US market that some sectors turned up in November and December of 2007, 3-4 months before the bottom of the S&P. We'll almost certainly see the same thing here again. So they're the ones that you want to focus on. Don't wring your hands about what might be happening to your current portfolio. Just look at what you can do, because there are things that we can do. Portfolio analyst last week was about a number of things, but how to participate while managing risk, obviously the most important thing at the moment, and just the reality of the mining industry in Australia at the moment, which I talked a little bit about with respect to gold, but it's also impacting in other areas of base metals and lithium. It's just where our market is sitting. It's temporary, it's transient, and we will get back to really buoyant prices again. We just have to wait until that starts to show its head. So that's it for this week. There's more information on my website. There's my email address, and I'll be back with you next Sunday. Cheers.